Over the last few years, stock option interest has exploded, and many new traders have entered the market. This is good, as it increases competition and tightens option pricing. However, the majority of new traders fail to understand the strategies on how to make consistent profits with options. So, we have set out to change that. You may or may not understand what an option is right away, but it's important not to give up. At first, options seem complex and puzzling for everyone due to their many dimensions. But just like anything else, the more you study, the easier they'll become. I also suggest that you take notes while you follow along, so you have something to refer back to for future reference. Just keep with it, and I promise it will all start to make perfect sense. I refer to options as the major leagues of investing. Option trading done right is where the serious investment money is made. But in order to make that money, you need to make sure you understand options, because almost all new traders start out losing money. Traders who take both our beginning and advanced course will get the proper foundation, the right tools, and the proper trading strategies to make consistent profits month after month with options. Members at our website, optionstrategiesinsider.com, will also always get real-time trade notifications of our exact trades, which on average have a 90% plus success rate. In the end, our students will have the complete picture on how to maximize their reward while balancing returns intelligently against risk. So, what is an option? An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a set date. The seller of the contract sells this right and is obligated to fulfill the buyer in exchange for receiving a payment called a premium. To simplify things, let's run through an example. Say we own a trucking company, and we think gas prices, which are currently trading at $2.50 a gallon, are going to surge higher over the next year, and we want to protect ourselves against raising prices. We could buy a contract that allows us to purchase gas for $2.80 a gallon, up to 10,000 gallons, for a price of 10 cents per gallon. Because this contract controls 10,000 gallons and it carries a premium of 10 cents a gallon, this contract will cost us $1,000 today. Now, why would anyone pay for a contract giving them the right to buy gas at $2.80 a gallon when it's currently priced at only $2.50 a gallon? That's a good question. And if gas prices stayed under $2.80, we would never exercise the contract. Why would we if gas prices in the open market are cheaper? This would result in a loss of that $1,000 premium we purchased the contract for. The seller of the contract would get $1,000 just for taking on risk that never ended up being an issue. Good for them. However, if gas prices were to shoot up to, say, $3.50 a gallon, this would be a totally different story. Because we purchased the right to buy gas at a price of $2.80, we can now force the seller to honor the agreement and sell us up to 10,000 gallons of gas for only $2.80. When everyone else pays $3.50. Our total savings is 70 cents per gallon times 10,000 gallons, or $7,000. Of course, we did have to pay $1,000 for this contract, so our total profit for buying this insurance on raising gas prices is going to be $6,000. This is basically how a call option works. There are going to be a few technical terms that come along with option trading. That's just the nature of the business. It can sound like a foreign language at first, but please don't let that stop you from learning how to trade options. There's not that much, and through repetition, it's going to all make sense very soon. Once you actually get through the course, which is full of examples and actual live trading, it's all going to make perfect sense. The understanding of what is actually happening will come with time. My promise to you is that I will get you there in the shortest amount of time possible, so you can start making money with options sooner rather than later. With that said, we have to lay a basic foundation. There are two types of options: call option contracts and put option contracts. A call option gives the buyer the right to purchase stock at a predetermined price and within a specified time period. This means there will be a limit to how long the buyer may wait. The more time given, the more the contract will cost. The seller of a call option is obligated to fulfill the rights of the buyer if that buyer chooses to exercise those rights. A put option is similar to a call option in regard to the rights given to the buyer. However, a put option works a little different. A put buyer can sell the stock at a predetermined price and within a specified time period. The seller of a put option is obligated to fulfill the rights of the buyer if they so choose to exercise their rights. So, now that we know a little about options, I want to cover some key option trading terms. First, call options control the purchase of stock, while put options control the sale of stock. Buyers of options, both calls and puts, have the rights, while sellers have an obligation to fulfill the rights of the buyer at the agreed-upon price and before the predetermined date. This agreed-upon price is known as the strike price, and the predetermined date is what we refer to as the option's expiration. One more point. One option contract, under normal circumstances, controls 100 shares of stock for both calls and puts. Okay, I know that's a lot to take in. So how about we run through some examples demonstrating how all this works? Let's pull together the terminology we just learned in a real scenario. Here, we're going to look at calls first to get a better understanding of why options are so powerful. For instance, we want to initiate a long position in the company XYZ, which is trading at $50. If we buy the stock, that means we're risking $50 times the amount of shares we want to buy. If we buy 100 shares, that's a $5,000 investment. However, options allow us to take a long position in the stock where we can avoid actually buying the stock and risking so much capital. First, we need to decide where we think the stock is going and what we can afford to risk. Over the next 2 months, if we think the stock is going to trade up to $58 and the price of a 55 strike price call option is $1.50, this will give us the ability to purchase the stock for the price of $55 anytime within the next 2 months. If the stock does trade up to $58, that's going to be great, as we can exercise the call option and buy the stock for $55, even though it's currently trading at $58. Our total cost per share is going to be the $55 plus the $1.50 cost of the option, for a total of $56.50. Because we can now sell the stock for $58, we just made a nice return of $1.50. This position only cost us $1.50. Being so, we have made a 100% return on capital in just 2 months, a far better return on capital versus just purchasing the stock. Another benefit of buying a call instead of the stock is that our max loss is also capped at the price we paid for the option. Had we purchased the stock and it traded down to $40, we would have lost $1,000. But because we instead decided to purchase an option, our max loss is limited to the cost of the option, no matter how far the stock trades down. Remember, one option contract controls 100 shares of stock. So if we purchase one contract for $1.50, our max loss is only $150. Next, let's take a look at put options. These are very similar to calls, but instead of giving us the right to buy stock, puts give us the right to sell stock. If we're looking to take a short position in the stock, we can either sell the stock short or buy puts. A lot of new traders understand calls, but it takes a little longer to get their heads around puts. People often buy puts instead of shorting stock, but it's also very common to use puts to protect a current portfolio, just like drivers buy car insurance to protect their vehicle. Although you have to pay insurance premiums, most hope they never actually use it. However, if there's an accident, they know they are protected. Puts are often used in a similar fashion. They allow the buyer of the put to sell stock at a predetermined price, and if a stock they own gets crushed, the investor has the right to exercise the puts and sell the position out, saving themselves from a larger loss. Let's look at stock XYZ again, which has now traded up to $62. And this time, we want to protect our profits against the stock trading back down to $50 in the near future. Here, we can look to buy a 55 put, which is priced at $1.25. If the stock trades down to $50, like we thought, That would mean we have the right to sell the stock at the 55 strike price, with the current market value of the stock at $50 for a $5 profit, minus the $1.25 we paid for the option, giving us a net profit of $3.75. Not bad for only a $1.25 investment. Okay, everyone. I hope you find this first lesson engaging and you're starting to get excited about option trading. In the next lesson, we're going to have a look at some of the benefits, warnings, and why investors might want to sell options. I look forward to seeing you there. Welcome back. As we can see, options give traders some huge benefits other investment vehicles cannot provide. Traders often start off with stock or another investment type, and then later graduate to options when they think they're ready for more involved investing. There are several reasons why educated traders eventually make the jump to options. They offer the highest return on capital, maximizing an investor's dollar. They allow investors to decide on their desired probability of success before putting on the trade, in essence, allowing traders to set their own desired risk tolerance. And finally, options allow traders to define their risk versus reward. By doing so, a trader can pair options together, capping their profits in exchange for limiting their losses. This type of control and flexibility is not possible in other investment vehicles. For those who are interested and want to make above-average returns, options allow them to do so. However, it comes at a cost. Options are not easy, at least at first. They require plenty of studying and experience. For those who have a desire to learn, they will all start to make sense and pay off very soon. Moving on, you have heard me talk about return on capital throughout this course. But what exactly is return on capital? Return on capital is the percentage that represents the amount of profit gained against the total investment size. It's calculated by simply taking the profit and dividing it by the investment. Return on capital is important because it shows how much an investor can earn for every dollar they invest. For example, if we bought an investment property for $300,000 and then that property generated $24,000 of rental income a year, we would have a return on capital for this investment of 8%. This same analogy works in option trading. If we make a trade that has a max profit of $1,000 and a max loss of $4,000, the investment bank will hold $4,000 in order to secure payment if this trade goes bad. If we hold this trade to expiration and are successful in reaching our max profit, our return on capital is going to be 25%. If we instead decide to buy the trade back early and only profit $400, our return on capital is going to be 10%. Most new investors have no idea what a good return on capital would be. If we bought this trade back a few weeks before expiration, we might have only made $400. So would this have been a good investment? Let's go back to our property example. There was an 8% return on the whole year. Did you think that was a good investment? At OptionStrategiesInsider.com, our average trade length is only about 30 days. So if we were to annualize our 10% return over a year, that would be an annual return of over 120%. So I think a 10% return over 30 days would be an amazing return. Even a 3% return monthly would add up fast over the course of a year. Just to give you some idea, if we invested $1,000 today and received a 3% compounded monthly return on our money, we would more than double our money in just 2 years. In this example, exactly 2 years from our investment date, our $1,000 would now be worth $2,032. The point is, as an option investor, there's no need to be overly aggressive. In fact, that's how most option traders get in trouble. We're happy to be making 1, 2, or 3% a month, and then every once in a while have a month where everything goes right and we pull in a much higher return. Over time, this turns into a lot of money. If you're getting excited about options, that's great news. But before you rush out and buy a bunch of calls or puts, there are certainly some negatives that come along with participating on the buy side of an option trading strategy. In the last lesson, we ran through some examples of investors looking to buy options and why they might want to do so. But for there to be a buyer, there also has to be a seller, which is just someone who is willing to take on the buyer's risk. Insurance companies normally perform this function in society. However, in the investment world, you don't have to be a big-time insurance agency like Geico or one of the many others to sell insurance. Anyone can do it, and for any size they feel comfortable with. The option seller takes in a premium in exchange for insuring the buyer's investment risk. The key to being a successful insurance agent, aka the seller of options, is to take on the best possible insurance situations. Car insurance agencies consider a lot of different factors when selling insurance: the person driving, the type of car, the miles driven per year, just to name a few. They then come back with a price that justifies their risk. Option sellers can do the same thing. Look at a company's fundamentals, understanding management, market perception, implied volatility, as well as many other possible factors that go into calculating if the risk warrants the reward. But why would anyone want to sell options when that comes with limited profits? And oftentimes, those profits are smaller than the max loss of the trade. That's a good question, and what's typically going through the head of most new option traders about now. Think of it like this. A car insurance company like Geico takes in many people's small premium payments, and every once in a while they have to pay out. But overall, they end up taking in way more money by selling insurance than they pay out to the people buying insurance. There are so many insurance companies today because the ones running their business intelligently are all making money hand over fist. The same goes for selling option premium. Those who do it intelligently will make money. I want to run through another example, except this time we'll be selling. But before we do that, I want to talk about calculating our break-evens. You may have noticed what our break-evens were on our previous examples, even though we didn't talk about it specifically. But before we run through our sell-side examples, let's discuss. It's very simple to calculate a break-even on an option trade. If we buy a 50-strike price call for $3, the stock has to reach $50 before we start making any money. But we still have to account for the $3 premium we paid for the option. So, easy enough. We simply add the premium to the strike price. Once the stock reaches $53, we've made a $3 profit on the call option, which covers the $3 premium we paid for the contract. So in this example, $53 would be our break-even. The break-even is calculated the same for both the buyer and the seller, except they're on opposite sides of the trade. If the stock finished right at $53 on expiration, this would be a tie, and both the buyer and seller would break even. Above 53, and the buyer would turn a profit and the seller would lose. Below 53, and the seller would win and the buyer would lose. Puts work very similarly, except we simply subtract the premium from the strike price to calculate the break-even. If we bought a 50-strike price put for $3, we would start making money once the stock trades below $50, but we would need to make up our $3 premium. So we would not reach a point of profitability until the stock reaches $47. With that said, let's take a look at stock ABC, which is trading at $45. If we believe it will not trade any higher over the next several months, we can sell a 50-strike price call 3 months out for a price of $4. The most we can hope to make on this trade is the $4, which is what we sold the call for. If the stock stays under $50, we'll in fact make the $4 we had hoped to. For every dollar it trades over $50, we lose $1. Of course, we were paid a $4 premium to take this trade, so we wouldn't start to take a loss on the trade until the stock penetrates $54, our break-even. For every dollar it trades over $54, it would be a loss. Let's now take a look at selling a put option. Like the call, the put option works the same way, but on the downside. Let's look at stock ABC once again. Only this time, we think the stock is going to keep moving higher. We decide to take a relatively aggressive approach and sell at the money put option, which means selling a put that has a strike price at the same level as where the stock is currently trading. We'll go 3 months out and sell the 45 strike put for $6.50. If the stock does continue to go higher and stays above $45 like we hope, our profit would be $6.50. Now, let's first figure out our break-even. For every dollar the stock trades under 45, we lose $1. We make $6.50 right off the top from the sale, so our break-even will be $38.50. As long as the stock doesn't trade under $38.50 in the next 3 months, this will be a winning trade. For every dollar ABC trades under $38.50, that will result in a loss of $1. All right, that concludes our lesson on learning the basics of calls and puts. If you've made it this far, then you're well on your way to learning the key fundamentals of option trading. Just be sure to keep watching, because we're going to show you far better ways to trade options than what you've seen thus far. There's a lot more to cover, so make sure you understand everything we've covered thus far with the quiz below, and I look forward to seeing you in the next video. In the last lesson, we learned the basics of calls and puts and why we might want to buy or sell them, and the risk versus reward for each strategy. But what many new option traders don't know is that, just like trading stock, you can buy and sell option contracts instantly on your computer with just a couple of mouse clicks. Here I have pulled up what is referred to as an option chain. This is a list of all the available options for a given stock listed by expiration date, with the most recent expiration on top, and then within that expiration by strike price, with the lowest strike price on top. We have two sides, calls on the left and puts on the right. This is a pretty standard format that you will find at most brokerage houses or websites, like Yahoo Finance. The platform I have up here right now is the Thinkorswim desktop software provided by TD Ameritrade. There are a lot of choices when it comes to a trading platform, but in our opinion, Thinkorswim is going to be your best bet. Thinkorswim is very powerful, free with any TD Ameritrade account, comes with some of the lowest fees in the industry, and has great support. For these reasons, it's also one of the most popular trading platforms out there. So no matter what you're trying to do, it's very easy to find answers. For these reasons, it's our first choice for an option trading platform. If you're using another broker or you're still trying to decide on a broker, we highly recommend signing up to TD Ameritrade. The advantages of the Thinkorswim platform are going to make trading a whole lot easier and more profitable. And if that wasn't enough, we have negotiated discounted commissions only for OptionStrategiesInsider.com members. So when you place a trade with TD Ameritrade, it will cost you less than everyone else. Coming back to Thinkorswim, we're looking at Netflix options. Netflix and most other publicly traded companies have options. In order to see if a stock has options, you just come up here and enter the stock symbol. If you have a company in mind and aren't sure what their stock symbol is, that's an easy fix. Just ask Google and they'll provide you that information. Let's go back and look at Netflix stock and look at the option chain with more detail. As previously discussed, the options are listed first by the date they expire. The option dates then go down in order, with the ones expiring in the longest amount of time on bottom. These ones down at the very bottom, that expire in a year or longer, are referred to as leaps due to their long duration. The option's expiration date is listed first thing on each bar. You have the day, month, and year of the option's expiration, and then after that, in parentheses, you have the number of days from today until that date. The rows that have text written in yellow are weekly options, while the ones listed in light gray are monthly options. Monthly options are what most people trade, and what we trade here at OptionStrategiesInsider.com. If we open up a month, we'll get a list of options available for trading, listed with call prices disseminated on the left, and puts are disseminated on the right. These are separated by strike price, which are listed going down the page from smallest to largest. On each line, there are prices for that option contract. Notice there's a bid price and an ask price, just like stock. The bid is the most someone is willing to pay for that option right now. The ask is what someone is willing to sell that option for right now. When the bid and the ask meet, then there is a trade. So, if we want to sell an option immediately, we would sell on the bid price, and if we wanted to buy an option immediately, we have to buy on the ask price. Let's discuss what would happen if we wanted to buy one of these call option contracts. First, we should understand that one option contract controls 100 shares of stock. So if we buy one of these option contracts, we will be allowed to buy 100 shares of stock at a price of $165 up until the date of September 15, 2017. And if we bought 10 contracts, we would be able to buy 1,000 shares at a price of $165 up until that date. For now, let's just stick with the strategy of buying one Netflix September 165 call option contract. How much is this going to cost us? Well, we have a couple of options. We could put out a buy for a lower price than the ask and hope someone takes it. If the market is $460 at $470 and we put out a bid of $465, there's a good chance someone might want to do that, and we may get a fill. However, if we don't want to take any chances and want an immediate fill, we would need to pay the ask price of $470. This price of $470 represents the price of one controlled share, and because one option contract controls 100 shares, this would end up costing us $470. Even though option contracts control 100 shares, the prices are listed on a per-share basis. So whatever the price is listed at, you would calculate the cost of the trade by multiplying the price times the number of contracts purchased, so times 100. If we wanted to purchase 10 contracts, we would pay $470 times 10 contracts times 100 shares for a total of $4,700. We would then have the right to control 1,000 shares of stock. If our stock prediction was correct and Netflix shot up to $175 per share, this would be a nice winning trade. We would have the right to buy 1,000 shares of stock at a price of $165 and sell it for $175. Now, you might be thinking, buying 1,000 shares at a price of $165 is still going to cost $165,000, and that is a lot more money than you have access to. The good news is, we don't actually have to buy the stock when we trade options. We can sell this option position back out for a huge profit in the exact same manner we bought it, and the cash just gets added right into our account without any stock ever coming into play. So if the 10 options we just purchased a month earlier for $470 per contract for a total of $4,700 is now worth $8 per contract for a total of $8,000, we can sell that back out, and now our bank has just increased by $3,300. Just like in this example, you don't have to wait until expiration to open or close a position. If you buy an option, you can sell that option back out at any time until it expires. Selling options works the same way. You can always buy it back until expiration. Now, let's talk a little bit about pricing. Options are referred to as in the money if they're currently in a position where they could be exercised. In the case of a 100 strike price call, when the stock goes over 100, the option would be in the money. If the call is trading under 100, it would be said to be out of the money. As you probably guessed, a 100 strike price put would be considered in the money if the stock trades below 100, and would be considered out of the money when it trades above 100. When it comes to option pricing, there are two main elements: intrinsic value and time value. The intrinsic value is easy to calculate for in-the-money options. It's the difference in the stock price and the strike price. So, if the stock XYZ is trading at 50, the 40 strike price call would have an intrinsic value of $10. This is the real value the option has right now. Out-of-the-money options would have no intrinsic value. If the 40 strike price call was selling for $12, it would be said that there is $2 worth of time value and $10 worth of intrinsic value. You can calculate time value by simply subtracting the intrinsic value from the total option premium. The more time you have to expiration, the more time value premium you're going to pay. This time value premium corresponds to the amount of time the option has to become more profitable. It would make sense that we would have to pay more for additional time to add further profits to the position. Alright, that concludes this lesson on stock options. I know this was a lot of information to take in, but I hope things are starting to come together. Just remember, everyone is confused by stock options when they first start out. You have calls and puts and then buys and sells on each one. It's logical that it would be confusing. Just take it slow, and soon it will all start to make sense. Remember, we're just covering the basics right now. The good news is you're learning from the ground up, and by the end of this course, you'll have a trading strategy in place that will allow you to make consistent profits trading options. While other people come right out of the gate and lose, you will have the knowledge and the support to succeed. All right, everyone. I look forward to seeing you in the next lesson, where we're going to learn all the factors that go into option pricing and how we can leverage them to our advantage. This is going to give us the building blocks to create successful option trading strategies that continue to pay. Just make sure you understand everything up until this point. Take advantage of the quiz below, and I will see you soon. Hello, everyone. In the last lesson, we left off talking about option pricing. Today, I want to talk about the elements that influence option pricing. There are 6 factors that can change the price of an option, some certainly more important and more powerful influencers than others. Many new option traders may not consider some of the minor influencers, or perhaps they don't even know about them. That's okay, but there will be times when they leave money on the table. So I want to make sure I cover all 6 factors so there's no question on why an option price might have changed. Once we understand how these pricing elements affect an option, we'll be able to execute trades that allow us to profit by taking advantage of the expected option price movements. These are factors that every option trader should know. In fact, when I got my first job in the options exchange, my boss would quiz me on these option pricing elements every few days. So I highly recommend you take notes, especially on this section. Once we cover the basics, we'll then be able to implement powerful strategies that capitalize on what we have learned. These 6 factors are the price of the stock, the selected strike price, the amount of time to expiration, the volatility of the option, interest rates, and if that stock offers dividends. Some of these things might look familiar, and they should, because we have discussed several of these factors already. Let's first talk about the price of a stock and how this affects option pricing. When we talk about a call, we know this gives us the right to buy stock at a certain price in the future. So it should be no surprise that the higher the stock goes, the more that option will be worth. Let's look at 2 scenarios. First, we own a call option with a strike price of $100, where the stock is currently trading at $90. Second, we own a call option with a strike price of $100, but the stock this time is currently trading at $120. Which would we rather own? Clearly, option 1 has less value. No one is going to exercise a call and buy stock for $100 when they can just go into the open market and buy it for $90. Option 2 is far more appealing. Being able to buy stock for $100 when it's currently trading $120 has far more value. There would be $20 worth of intrinsic value in this option, plus the remaining time value. Puts work the same way, but in reverse. Would we rather own a $100 strike price put, which means we can sell the stock at $100, when the stock is trading $110 or trading $80? Obviously, owning a put contract that allows you to sell stock at $100 when the stock is currently trading $80 is going to have more value. Because stock prices are always changing, if you own a call and the stock goes up in value, then your call will also go up in value. However, this has an inverse effect on puts. Stock price increase means put price decrease. Furthermore, if you own a put option and the stock price decreases, then that will cause your puts value to increase. Just like with the other scenario, when puts increase, calls decrease. So a stock going down in value will cause the call options to also go down in value. This brings us to the strike price, which is our second pricing factor. In the previous example, we owned a 100 strike price option, and we evaluated what happened when the stock moved. But now let's take a look at our option chain and see how our strike price values based on which strike we consider. Here I have pulled up Disney stock on our favorite platform, Thinkorswim, which is currently trading about $107. Thinkorswim does a great job of separating the in-the-money options from the out-of-the-money options. In-the-money options have a purplish background, while out-of-the-money options have a black background. Remembering from before, when a call is in the money, it means the stock is trading at a price higher than the strike price. When a put is in the money, it means the stock is trading at a price lower than the strike price. In the case of Disney, any call option strike below $107 is going to be in the money. Any put strike above $107 is going to be in the money. Strike prices that are deeper in the money have more value. In the case of Disney, we can see this very clearly. A 105 strike price call is worth about $455 less than a 100 strike price call, which is worth about $460 less than the 95 strike price call. Having the right to buy stock for a lesser price translates into more value for that option. In the case of puts, if we want the right to sell stock for a higher price, that translates into paying more for that put. We could buy the right to sell Disney stock at $140 per share within the next 28 days, but that's going to cost us a hefty $34.80, or $3,480 per contract. Remember, option contracts control 100 shares. If we decided to buy the 120 put instead, that would cost us a lot less money. Being able to sell Disney stock at $120 a share has a lot of value when the stock's trading at $107, but that certainly has less value than being able to sell the stock at $140. This makes sense, as we can tell from our option chain. The deeper the option is in the money, the more expensive that option is. This is because the better strike price execution we get on that option, the more value that option has. When it comes to an option's value on expiration, there's no time value left, as the option is expiring and its life is ending. If that option is out of the money, it won't have any value at all, and that option will expire worthless. If that option is in the money, the option's value will be made up of 100% intrinsic value, the difference between the strike price and the stock price. Basically, if we have a 100 strike price call and that stock is trading 107, then that option will be worth $7. If we have a 100 strike price put and that stock is trading 89, then that option will be worth $11. Let's head back to Disney and take a look at the May options that expired today. Disney closed at 107.52. Now, these marks might be off by a couple of cents because the mark figures are the average of the bid and the ask, and people are going to be bidding a few cents less than what the option is worth and asking a few cents more. This is because traders are not willing to do a trade unless they have something to show for it. They're going to want to earn a few cents for their troubles, or there is no point in making the trade. As you can see, no one is bidding for these worthless, out-of-the-money options shown in the black area. But there are certainly people willing to sell them as they have zero value. And selling something with zero value, even for a few cents, is better than nothing. These out-of-the-money strikes would rarely ever trade, but there's a market there, just in case. Looking through the option chain, we see the 107 call should be worth about 52 cents, and it is. The 104 strike price call has $3.52 of intrinsic value, and that is right in the range of where it finished trading. For every dollar we go deeper into the money, the option will also increase by $1. Looking at the puts, the 110 put should have a value of about $2.48, and we can see that's also right where it ended up. Remember this, because owners of these puts will be allowed to sell stock at a price of $110, with the stock's real value at $107.52. This means there is $2.48 of intrinsic value, and that is the only value these puts have, as they have just expired. So, just to review, Out-of-the-money options, once they expire, have a value of 0. In-the-money options have a value of only their intrinsic value, which is calculated by taking the difference between the stock price and the strike price. Looking back at our June expiration, which is next month, we see out-of-the-money options have some value. And if we look even further out in time to September, which is 4 months away, we see those same strike prices have even more value. So what's happening here? And why do these out-of-the-money options have value? These options have value because they have our third point in option pricing, more time to expiration, what we commonly refer to as time value. Options have a limited lifespan, thus their value is affected by the passage of time. The more time an option has, the more value that option has. If we have a car that is worth $30,000 and we go to buy insurance, we will have to pay a premium of $100 every month. That insurance contract is good for 1 month, and every month we must buy a new one for $100. We also have an option to buy the exact same insurance, but to pay every 6 months, and that will cost us $600. Options work the same. We can buy 1-month coverage, or we can buy 6-month coverage. We just have to be certain about the length of coverage we want. In our car insurance example, if we only buy 1 month of car insurance, forget to pay our bill, and then have an accident the day after our insurance lapses, it's too bad, so sad. Our insurance company will not cover our car, and we will have to eat the full cost of the damages. Well, guess what? Options work the same way. If we own a 1-month put option, and the day after our put expires, the CEO of the company dies and the stock gets crushed, we're not covered, and we get no benefit. So, the more time we want, the more it will cost us. Going back to Disney, we see our September 100 puts are, in fact, out of the money, but they still have $1.64 of value because stock prices move, and they give us a protection against downward stock movement over the next 4 months. Disney could very easily take a turn for the worse, and that 100 put that's currently out of the money now could finish in the money by September. Until that option expires worthless, there's always a chance it could finish in the money, and that's why it still has value. Looking at our Disney option chain, we can see that the further out of the money the option is, the smaller the contract price. That's due to the fact that the further out of the money we go, the lower the probability of that option finishing in the money. And if it does finish in the money, the exercise price will be at a lesser value. As we just discussed, the more time the option has to expiration, the more that option is worth. However, as that time to expiration gets closer, the value of that option begins to decrease. With every passing day, there's a little less time to expiration, and that less time is reflected in the option price. For these reasons, options are considered to be decaying assets. For example, if we purchased one Disney September 100 put for $168, and the stock just stayed right where it was, trading sideways over the next 4 months, that put would start to decay away. With 4 months to expiration and the stock trading at 107, that put is worth $168. However, next month, with the stock in the same place, that put is only going to be worth $121. In July, with the stock still trading 107, the value will fall to only $64. In August, only $20. And in September, it will be worth nothing. Where would the stock have to go for us to break even? Remember, with puts, we calculate our break-even by subtracting our option premium per share of $168 from our strike price of $100. So our break-even would be $98.32. We start cutting into our losses once the stock goes under 100, but we do not start to turn a profit on this trade until the stock goes under $98.32. As you can see, time would be our biggest enemy, decaying our option away, reducing its value so that it expires before we could reach a point of profitability. This is why successful option traders don't go nuts buying out-of-the-money options. Not only will the stock have to move in our favor, but it will have to move enough to account for all that time decay. We can measure this time decay in something called theta, which represents the amount the option decreases in value daily due to time decay. This is why at OptionsStrategiesInsider.com, we choose a strategy that takes advantage of time decay. And instead of having time be our enemy, time becomes our ally. Now, don't worry, we're going to talk more about this later. For right now, I just want to make sure you understand why going out and buying a bunch of options is not a good strategy for success. So far, we have covered the first 3 factors of option pricing. These include the stock pricing and how the fluctuation of a stock's price affects the option's value, how the strike price chosen will affect the value of that option, and the likelihood of it finishing in the money at expiration. Finally, how options are decaying assets that have limited lifespans, thus losing their value little by little with each passing day. Later on in this course, we're going to talk a lot more about time decay and how successful option traders use it to their advantage. So I urge you to make sure you finish this course. All right, I know this was a lot to take in, so let's stop right here. And in our next lesson, we'll start fresh with our 4th option pricing factor, and my personal favorite, volatility. See you soon. Hello, everyone. In this lesson, what I want to do is pull up the Thinkorswim platform and look at how some of the factors we just discussed actually change the option's price. This is not something you need to take notes on. I just want to demonstrate how important these main pricing elements are in affecting the option's pricing, so you can see firsthand what small changes can do. For this demonstration, I'm going to use a tool within the Thinkorswim platform called TheoPrice. This is a tool that will allow us to hypothetically change elements of the pricing model to see how it would affect the option's price. Here I have up NVIDIA, and I am looking at the June options. If I look at the 138 calls, which expire in 24 days, I see it has a current mark price of $4.02. Now, let's see what happens if I make some adjustments to the pricing factors discussed in the last lesson. I want to start off with the strike price. Looking at the calls, it's easy to see that the lower the strike price, the higher the option's cost. In the case of puts, the higher the strike price, the higher the option's cost. Not surprising, this is due to the fact that the deeper into the money we're allowed to exercise our option, the more value that option is going to be worth. Options that are out of the money today can finish in the money, but if they don't, they become worthless. So let's see what happens to our 138 call when we adjust the price of NVIDIA. In this example, all other pricing elements will remain the same, but the price of the stock will shoot up $5. Here, the price of the option changes to $6.72. Clearly, this has a very large effect on the option, because the likelihood of the option finishing in the money is substantially greater. If the stock dropped $5, the option pricing for the 138 call would instead plummet to $2.13. Without a doubt, this type of movement in the stock would cripple these options' chances of finishing within the money, and the option pricing now reflects that. I want to reset the stock's price back to the current price, and I want to look and see what happens if we were to change the date with no other pricing factor changing. I want to see what will happen with each passing day. As we gradually go through the days left until expiration, we see this poor option is slowly but surely losing its value, day after day decaying a little more until finally the option's price approaches and then reaches zero. Remember, an option will only have intrinsic value when it expires, and all out-of-the-money options will expire worthless. So, if NVIDIA was to expire next month at the price it's currently trading at now, the 138 call would have no intrinsic value. And since it's out of time value, this option is now worthless, and anyone who bought this call would have lost their entire investment. Let's now reset our position and have a look at what happens to option pricing if the implied volatility changes. If you recall, when implied volatility rises, then that stock's options, both calls and puts, will also rise in value. So for this example, our stock is going to stay the same. Our days to expiration is also going to stay the same, and only implied volatility will change. Let's assume a random market event happened, and the implied volatility has jumped up 30%. This has changed the option price from $4.02 to $8.28. So if we were long this position, we have greatly benefited from this spike in implied volatility, and our position is now profitable without any change in the price of the stock. We could then sell this option back out right now for a huge profit. Keep in mind, these are isolated cases where we look closely at just one pricing element of the stock. But in real life, all of these elements are always changing. So let's take a look at how pricing of an option might change in a couple more scenarios. How about we look at the price of an option 10 days from today, and the stock price is going to be up $3. That would likely drop implied volatility by probably 0.5%. This would result in the option price of $4.44. Obviously, we lost value from the decay, which is unavoidable, and we lost slightly with the decrease of implied volatility. But we were able to make up for both of these factors due to the price movement in the stock and still turn a slight profit. But keep in mind, we called the direction of the stock right. It moved up $3, and we still only made a small profit. Another situation. This time the option increased by $5. However, it took 3 weeks for this to happen. And implied volatility is still down only 0.5%. Here, we can see the stock went up by even more than our first example, but time decay is really starting to eat away at our profits. We were right about the direction of the stock, but it took too long, and that time decay is costing us big time. This time, even though the stock is up $5, we lost money. How about one last situation where the stock price has a $1 increase? Only a week has gone by, but implied volatility has dropped by 20%. We still have a lot of time to expiration, but because the stock is not expected to move much over the period, it has little chance to make any significant upward movement, and the price of the options now reflect that by dropping significantly. The option is now only worth $1.34, even though the stock price has gone up, resulting in a huge loss. Looking back at the option, as it turns out, in most of these situations, we ended up losing money even though we called the direction of the stock correctly. If we would have just bought the stock, we would have been better off. So you might be thinking, why did we even buy this option? And my answer to that is, exactly. We bought the option in all of these situations. The person who sold the option was in a better position to win right from the start, and in most cases, they did. The problem is, most new option traders do something similar to this. They buy out-of-the-money options and then hope that the stock's price movement more than makes up for the loss in time decay and volatility. However, getting the stock movement right is difficult, but at the same time to also have it move up by an amount large enough to counter the time decay and implied volatility, well, that's hard to do. The fact is, people who end up buying options typically lose more than they win, and oftentimes a lot more. Fortunately, you don't have to be on the buy side. Once we understand how options work and how we can limit our risk, even when on the sell side, we will be able to take advantage of selling options and getting time decay and implied volatility to work for us, not against us. While everyone else is concentrating on the price of the stock, we'll be laughing all the way to the bank. Most option traders fail because they're trying to predict where the stock is going, and in the process cash in a big payday, but over the long haul, crash and burn time and time again. The advanced strategies that we're going to implement will not concentrate on where the stock is going, but instead on where the stock isn't going, and then collecting on the time decay and the volatility changes. I hope you're getting excited because we're not that far away from getting into the advanced course that's going to make us the real money. Please make sure you understand everything up to this point and be sure to take the quiz. I look forward to seeing you in the next lesson.